What's going on, everybody? Sean Morrissey, Chicagoland Realty Group Partners, back this week with another educational video regarding real estate investments. So what we're going to talk about today is cash flow versus appreciation. The advantages to each, a few disadvantages, and then ultimately how to perceive each of those in your given marketplace or locations you're exploring. So let's start with cash flow, right? Now, frankly speaking, cash flow is always my primary underwriting tool. Whenever I'm looking at properties, I am looking for a positive net operating income on any property I buy from day one. And the reason for that is that it becomes the most stable form of investment for the real estate investor. Very little speculation involved. You can forecast rents minus your expenses and achieve a net operating income, which also can be termed as your cash flow. Now, having said all that, whenever we go to refinance a property on a commercial basis, that net operating income or cash flow is a very valuable tool to the bank because it in essence tells the bank what your property is worth based on a given capitalization rate or multiple of that net operating income. So whenever you're able to drive net operating income up, you're in essence driving the value of your property up just based on the cash flow alone. All great reasons why I love cash flow. Appreciation, on the other hand, in my opinion, can be a very speculative form of return. However, the flip side of that is that that speculation could make you very wealthy very quick, so long as you find the right market with the right demographics in place to progress upward over the whole time frame that you're looking to explore. So, having said all that, let's talk about capitalization rate and how that plays into both cash flow and appreciation. So first and foremost, cap rate is a calculation in which we're going to take the net operating income, divide it by the sales price, and in essence, get a snapshot in that point of time of what the return on that net operating income is. So in any given market right now, you may see a cap rate of 5 to 7%. If you were to find a property in a market with a cap rate higher than 7%, let's just say 10%, you could say, my goodness, I get phenomenal cash flow or net operating income from this particular property. But why is that? Well, the trade-off typically is that it's not in a market that is appreciating well. On the flip side of that, let's say you find a property with a very low cap rate, or let's just say 4%. That particular property is telling us that the appreciation in that market is very strong, hence the cash flow is very weak. So your goal as an investor is to find that delta between where you can find a property which obtains good cash flow and good appreciation, or even better, great cash flow with the prospects of obtaining great appreciation. So how do you do that? Well, the first thing you should do is study markets, right? And dig a little bit deeper in regards to what particular metro areas have great cash flow with the prospects of appreciating great. So if we look at the Chicagoland market, we could say, boy, Chicagoland as a whole doesn't appreciate well compared to California. But if we look into pockets of Chicagoland, there are pockets where the cash flow is still great, with the prospects being good to very good. Having said all that, if you want to know what those pockets are, if you want to explore those pockets with me, feel free to check out our website, chicago-realty-group.com, or subscribe to this channel. We'll have some more educational videos to talk about great ways in which we can find opportunities in any given real estate market. In the meantime, thanks for taking 4 minutes out of your day to watch this video. Hopefully it was helpful. And subscribe if you think that this video will be helpful to you in the future and help others. Thanks, guys.